Okay, good afternoon, ladies and gentlemen. My name is Steve Meredith. I'm the Business Finance Manager with the Southwestern Pennsylvania Commission. Today's webinar is titled Financing Your Business with SPC, How to Get Started and What to Expect. And it's really meant to be an overview of SPC's traditional lending products. Before I get into the business finance program, however, I do want to take a minute to talk to you a little bit about what SPC is as an organization. SPC is a regional planning agency, a metropolitan planning organization, a local development district, and they are a core funded partner and fiscal agent for the Southwestern Pennsylvania Partnership for Regional Economic Performance, or PREP. Now, a lot of that are acronyms, and it's a little bit like alphabet soup. So from an economic development perspective, though, you can think of SPC as the region's agency to help small businesses, help the regional economy grow and prosper. Now, where the business finance department comes in, where SPC's loan programs come in, is that we provide low interest financing for land, building, construction, renovation, machinery or equipment purchases, or working capital to businesses that are unable to fully finance projects. Now, I do have an asterisk here by the working capital bullet here, and I want to clarify what we can use our working capital for. So let's say, for the sake of argument, you own a print shop. And up until this point, you've printed business cards and stationery and all manner of paper products. And then one day you decide that it's in your business's best interest to break into the screen printing business so that you can start printing t-shirts and hats and sweatshirts and all that stuff. You're going to need a new piece of machinery to facilitate that new product line. You can take an SPC loan to purchase that piece of machinery and then take a working capital loan with SPC to train your staff on how to use that piece of equipment. Similarly, if you're a manufacturer, and let's say, for the sake of argument, you have been manufacturing these widgets out of a very small warehouse, and the problem with that is that you have run out of space. You have so much inventory that you're feeling cramped and you can't finish your manufacturing process because you have so much inventory everywhere. You can take an SPC loan to purchase a building that you can use as your warehouse. And then you can take a working capital loan to fill that warehouse with your inventory. So when I say working capital, the working capital has to be related to a land or building acquisition, a construction or renovation project, or a machinery or equipment purchase. Now, one of the reasons that SPC's loans are so attractive to our borrowers is because we have very favorable interest rates and terms. Right now, our interest rates are between 0% and 2.5% fixed, not only at the time of application and the time of approval, but they're fixed throughout the life of the loan. And when you take a look at our terms, if you're taking a land or building loan, and it's a straight land or building loan, you're talking about having that low interest rate locked in for up to 15 years. That's a huge benefit. From a machinery equipment perspective, we offer 7 to 10-year terms. And for working capital loans, we offer a 1 to 3-year term. Now, this slide actually blends together quite nicely with the next slide, because the term of our loan actually depends on the term of a private bank loan. That is because one of the first loan program requirements that we have is that every single loan that we make to a small business has to contain matching financing from the private sector or through an equity contribution from the borrower. Typically, what we ask our borrower to do is we ask them to bring 10% of the total project cost to the deal in equity. And then the remaining 90% is split evenly between SPC and a private bank. So essentially what happens is the business owner gets 2 separate loans for the same amount of money. One comes from SPC and one comes from a private bank. So when you're talking about the split, 45% of the total project cost comes from SPC, the other 45% comes from a private bank, and then your 10% equity rounds up the entire project, okay? Now, from a collateral perspective, we do not do unsecured loans. Typically, the asset that is being financed is offered as collateral, okay? So if you're buying a building, we're gonna ask you to take a mortgage on that building. if you're buying a piece of equipment, we're going to place a lien on that piece of equipment. In addition to the collateral, however, we do require personal and corporate guarantees from our borrowers. There are rare exceptions made, but I always put the personal and corporate guarantees into the slideshow because more often than not, we actually do need them. And then finally, we have an economic development component with all of our loans, and that states that your project must create or retain one job. Well, it must retain one job for every $35,000 borrowed and create one job for every $50,000 borrowed. So I'll repeat that, okay? From a jobs perspective, your project must retain one job for every $35,000 borrowed or create one job for every $50,000 borrowed. And either instance of that economic development component has to occur within 3 years of the disbursement of the loan proceeds, okay? So it doesn't matter how long your loan term is. It could be a 15-year term. If you don't meet that economic development component by the end of 3 years, you could face an interest rate hike, okay? You could face an increase in the interest rate. Now, I will say this, that is the only instance in which we would ever raise your interest rate, is if you failed to meet that economic development component. If you do meet that economic development component, you have that interest rate locked in for the life of the loan, okay? So, moving right along. The application requirements. So obviously SPC is going to provide the loan application. You've got to complete all the sections. But in addition to the paperwork we ask you to complete, we ask you also to submit the list of documents on the screen here. So 3 years of company financial statements, the past 3 years worth of business and personal federal tax returns, commitment letters from all other funding sources. You need to have sufficient cash flow to meet the debt service. That's an underwriting term, right? So we need to make sure that you can actually support the debt that you're about to take. And then in pretty much all cases, we ask for key person life insurance or a life insurance policy on the key members, the key guarantors for the loan. Okay, so and the only way that we would ever collect on that life insurance policy is in the event of that key person's death. So we're talking about the CEO, or if the chief financial officer has over 20% ownership in the company, we'll need a key person life insurance policy on that person, or anybody with over 20% stake in the business in terms of the ownership. Okay. So now, a common question that I get with this slide is, what if I'm a startup? What if I have not been in business for 3 years? It's a common question. We deal with startup businesses all the time. If you have not been in business for 3 years, what we're going to need is a copy of your business plan and 3 years worth of your financial projections. And the one caveat that I will add to this slide is that we like, and the banks that we partner with like, to see that your business plan has been reviewed by a small business development center. Okay, so if you have a business plan and you have financial projections, but they haven't been reviewed by an SBDC, what I will do is I will refer you to either the Duquesne SBDC or the Pitt SBDC or the St. Vincent College SBDC or any of the small business development centers in the Southwestern Pennsylvania region. The director or the staff there will review it. It'll give you the go-ahead, and then we can move forward with the financing discussion. Okay, so the loan application process. Every single loan opportunity that we have here at SPC starts the same way, and that's with a pre-application discussion with the borrower. Okay, we need to find out what your project entails, how much of it is going to be a building purchase, an equipment purchase, how much working capital do you need. We need to find out if SPC is the right lender for you, and that the only way that can happen is through a pre-application discussion with the borrower. Now, once that happens, assuming that everything goes well with that application, or that discussion rather, what I will do is I will loop in one of the banks that SPC works with on a regular basis. And I'll say, hey, Bob Jones has this idea for to expand his business, and he needs a new building to facilitate that expansion. The total project cost is going to be $300,000. Would your bank be interested in partnering on this opportunity. And then the bank gets back to me, they say yes or no. Assuming they say yes, what I will do is I will set up a three-way call with the borrower, myself, and a representative from that bank, and we'll discuss the structure, okay? After that call, I will send you an application, and I will work with you to complete that application as much or as little as you want, okay? I can be as hands-on or as hands-off as you want. But once we get those application documents back from you, I will send that loan application down to our underwriter to underwrite the loan and pool your credit. Now, our underwriter, his name is Todd Stranko. He's excellent at what he does, but he might have some clarifying questions for you. So after I send the loan to my underwriter, he may reach out to you to say, hey, I noticed on your tax return it said XYZ. Can you explain that a little bit? What happened there? I tell people this because I don't want them to get nervous when he gives you a call. He's just looking for clarification. He's just looking for some questions to be answered. It's completely normal, okay? After the loan is underwritten and the credit is pooled and everything like that, our loan is presented to the appropriate review committees for approval, okay? We have two committees that need to review each loan at the very least, okay? We have a loan review committee that meets once a month on the third Wednesday of every month. And assuming they approve the loan, then the loan is going to be moved to our executive committee that meets the following Monday after that third Wednesday. Okay, so it's a very quick 2 approvals. All right. The only exception to the 2 approval rule is if your loan is backed by the state government. Okay, if we have to make a loan backed by the Commonwealth of Pennsylvania, let's say our portion of the loan is like $500,000. We cannot do a loan for $500,000 out of our internal revolving loan funds. The maximum amount of money that we can lend out of our internal revolving loan funds is $300,000. But our state loans, we can lend up to $2 million. Okay, so let's say your total project cost, the SPC's portion of your total project cost is going to be something like $500,000. In that regard, we would have to make that a state-backed loan. And the way the approval process would work there is that we would get our loan review committee's approval, we would get our executive committee approval, and then we would have to send it up to the state for their ultimate final approval, okay? Each one of these loans, I think it's very important to recognize that each one of SPC's loans usually takes 1 to 3 months to come about, okay? So have that timeline in mind. If you need a quick turnaround with cash, I may refer you to another lender simply because of our timeline, okay? But once approved, you can start working with our business loan servicer to get the closing scheduled and taken care of. And typically for our internal revolving loan funds, we can close within 8 days of the final approval, okay? All it depends on is how quickly our legal counsel gets our legal documents back to us for your loan, okay? So moving right along. Applicable fees, okay? I always like to be upfront about our fees because I find that to be the best practice. We have an application fee that is equivalent to 1% of the loan amount due at submission. At the time you submit your application. Now, when I say it's 1% of the loan amount, I'm talking just SPC's loan amount, okay? So let's say for the sake of argument, your total project cost was $200,000. If you bring 10% of that total project cost, which is $20,000, SPC would then split the remaining $180,000 with a private bank, which essentially means you would be getting a $90,000 loan from SPC. That application fee is going to be 1% of our $90,000 loan, and it's due at the time that you submit your application, okay? The second fee is an annual servicing fee that is due on the anniversary of your loan closing date, and that is equivalent to 0.5% of the outstanding principal on your loan. So if you think about it, as you pay down your loan, that annual servicing fee is going to go down. Now, once you get that balance on your SPC loan down below $50,000, our annual servicing fee becomes a flat $250 fee until your loan is paid off. And speaking of payoff, SPC does not charge a prepayment penalty. Okay, so you can pay off the entire remaining balance on your SPC loan at any time. I'll give you a quick anecdote here. Last fall, we had a couple of clients who, in spite of COVID, had a really good quarter or really good 6 months. And they came to me and they said, hey, we have a $161,000 balance on our SPC loan, but we had a really good quarter. We'd like to pay that off. That's no problem for us. What we did is we got them a payoff figure. They paid off that loan and got that debt off their books, which essentially, I mean, I think some of these loans were 7 to 10 years in the length of its term. So you're wiping out 7 to 10 years of debt all at once, and you do not pay a prepayment penalty for SPC. Okay. Finally, as much as I wish I could help borrowers finance the legal costs associated with their loan, from a regulatory perspective, we're not allowed to have that happen, okay? So the legal fees are the responsibility of the borrower, and it's just for the preparation of the closing documents, okay? So I wanna make sure that you guys know that's gonna be an upfront cost. Those legal fees are gonna be an upfront cost. And with that, that concludes my overview of SPC's standard loan programs. Here is my contact information if you want to get in contact with me. Right now, I am in the office 2 days a week and then out of the office 3 days a week. I'm in the office Monday and Tuesday, and then I'm out of the office Wednesday through Friday. Okay, so probably the best way to get a hold of me is via email. The other way that you can connect with me is via LinkedIn. There is my LinkedIn URL. I always enjoy meeting new small business owners via that social media and facilitating conversation that way. So thank you very much for watching this, and feel free to reach out to me if you have any questions at all. Thank you.